Hello, investors, traders, and degenerate gamblers. This is Beast McFeast here with 10 option terms that all beginners need to know. We'll start with what is an option? Options are contracts that you can buy and sell at any time, and these give the buyer of the contract the ability to buy or sell lots of 100 shares at a specific price. Now, whether or not you're buying or selling depends on which kind of option you get. We'll get into the varieties in just a minute here. On the other side of this trade is the seller of the contract. Someone sells you the contract that you're buying, and they're obligated to be the other side of the trade that you have locked in using your option contract until they expire. Now, you can use these options to profit in various market conditions that shares might not be appropriate for. And they come in two main types. The first type we're going to discuss is puts. These are, if you're buying them, bearish, meaning that you're hoping that the underlying, the stock that this is tied to, goes down. So when the underlying goes down, the value of your put goes up, all other things being equal. It's not quite that simple, and you're going to have to get into the Greeks, sort of understand the behind the scenes of how options work, and I'll make another video on that in the future. Now, how puts work is they allow the contract holder, the person who buys it, to sell shares at a predetermined price regardless of the market value. So you wouldn't want to sell your shares if the market price on the stock is higher, but let's say you buy a put and you set the price at like $60 and then the price per share drops to $30. Well, you can then go to the market, buy shares for $30 and sell them to whoever sold you this put for $60. It's a pretty good deal if the price of the underlying goes your way. The other type of option is a call option. This allows you to profit from upward moves in the underlying. Similar to shares, but not quite exactly the same, and we're going to get into that in just a minute here. Call options allow the holder to buy shares at a predetermined price regardless of the market price. So let's say you want to trade SPY, SPY, and you have a call at $450 and SPY is sitting at, I don't know, $455. Well, you can just go ahead and buy them using your call contract at $450 and then sell it, pocket the difference, which is about $500 because you're trading in lots of 100 shares. Not a bad deal. So I mentioned that there's a predetermined price. This is called the strike price. This is for a put, it's the price that put holders can sell their shares and that call holders can buy their shares. You'll have a variety of strikes to choose from when you're looking to buy or sell an option. Premium is the current value of an options contract. If you want to buy an option, you have to pay a premium. The premium is less than the cost of the 100 shares that it'll allow you control of, but it's going to vary wildly. It's always going to be less than those 100 shares, though. On the other side of the trade, if you're the seller, you're going to receive the premium. The value of the premium depends on strike price and how long the option contract will last and various market conditions. And those are going to require an additional video or two to get into because they get rather complicated to understand mathematically, but to get to them conceptually, it's not so tough. Expiration. So when you buy or sell options, they have a date where they either go into effect or expire worthless. When you're going into a trade to buy or sell an option, there's going to be several dates to choose from. These can go out several years to a couple of days, weeks, months. It varies. Different tickers have different expirations available. For the most part, you're going to see that they expire on Fridays. So you want to be careful with when your option expires because a lot of people get caught up saying, okay, my option's going to expire on this date. It's a Friday. And they say, okay, the end of the market day is when it expires. But after market changes can affect your option, and these can come with additional risk or potential rewards for you. Just be cautious and be mindful of when exactly they expire. And you can call up your broker to get a better idea on that, because it varies from broker to broker. Some brokers will close out your worthless positions before market close. Exercise is to execute the contract. This can be done at any time with US options, and if you're on a broker in the United States, you are trading US options, meaning that if you have a call, you can go ahead and say, I want to buy these shares at the strike price, and then I can decide if I want to sell these shares at the market price or not. The buyer has the choice on when to execute. The seller has really no say in the matter. You sold the contract, you can ride it out or buy your contract back for whatever the premium's at currently. Out of the money, always abbreviated OTM. These are options that would lose money if executed, regardless of the premium. So you wouldn't execute a call if your strike price was over the market price, because you would lose the difference between those two. You can buy or sell contracts that are out of the money, and this is a viable strategy to get into trades that are prohibitively expensive or to generate income in your account by selling contracts. In the money options, abbreviated ITM, they are options that can be executed at a profit if you ignore premium. If you're buying an option, you want that option to end up in the money. But being in the money is not a guarantee that you profit, because you can go and buy an in the money contract and you would lose money if you execute it, because the premium will always exceed what you would gain from immediate execution. There is no free money cheat where you can buy an in the money option and execute it immediately for a profit. Feel free to look, you're not going to find it. So convexity is not discussed too often, but it's one thing that makes options really appealing, and this sort of describes the leverage that you find in an options contract. The option price is not linearly related to an underlying price. So if you have a call in stock XYZ and it's at $10 and your strike price is $11 and stock XYZ jumps up to $11, that's a 10% increase in the underlying. The chances are pretty high that your actual contract is going to go up much more than 10% in value if it happens rapidly enough and you're not about to expire. I've gotten this graph here, and this is the price of SPY options with 2 days till expiration, centered on a market price of $445.44. And what you can see is that it's not a straight slope, depending on how far in the money or out of the money you're buying. This is going to contribute to your convexity. As something that's out of the money goes in the money, the increase in value is not a straight line, it's a hockey stick. One important thing to note about the options in this non-linear correlation between underlying price and option price is that you can get really high percentage changes in your options that you will never see in shares. You'll see options contracts increase in value 10 times their purchase price on relatively small moves in an underlying if there's enough time left on the option. So these things can move up or down very sharply. It's not all rosy though, because when the trade goes against you, it goes against you much faster than if you had shares, and they can expire. If they expire out of the money, they are of course worthless, meaning they go to zero. You probably don't want to hold your options to zero if you can avoid it. Sell out early at a loss. Thank you for watching. Please leave any questions you have in the comments. Good luck in your trading. Get rich. Bye.